Hello everyone, welcome to today's US Open live session, 10 minutes before Wall Street opens every day as always. Today it is Tuesday, February the 6th. I am your host Nikos Tsabouras, Senior Financial Editorial Writer at FXCM. Quite a few things to talk about today as well. The main event of the day was the Reserve Bank of Australia, which stood pat on rates once again, but did not rule out further hikes, thus putting a hawkish spin to the decision. And we're gonna talk about the reaction of the Aussie versus the US dollar. We're also gonna talk about the euro dollar as always and the Nasdaq. We're gonna also discuss the oil outlook. We saw renewed pressures recently, partly due to the repricing around the Fed. And we're also going to talk about Disney's stock, which in an interesting technical place as it has formed a golden cross. And also it has the earnings coming up tomorrow. So that's what we'll be talking about today. But before we begin, as always, please read carefully through the risk warnings and the disclaimers. Once again, please go over the risk warnings and the disclaimers carefully and bear in mind that anything discussed in this session does not constitute investment advice and should not be construed as such. We'll give you a few more seconds to read through and then we will begin. Okay, let's get the ball rolling. We have quite a few things to cover today. We're gonna start with the Aussie versus the greenback and the policy decision today from the Reserve Bank of Australia. Then we're gonna move on to Euro USD. We're also gonna talk about US oil as we saw a renewed pressure in oil prices, partly due to the Fed's repricing, to the repricing around the Fed. We're gonna cover the Nasdaq as usual as well, and we're gonna round things off with Disney. The stock of the entertainment giant is in a very interesting technical place, and we have the earnings coming up, which could set the tone for its trajectory going forward. So let's start with the RBA, the Reserve Bank of Australia. Of course, if there are any opinions and comments on what we are talking about, feel free to type them in the chat box, or if there are any questions, of course. So the Reserve Bank of Australia held rates at 4.35% as widely expected. Today, inflation has been coming down, the labour market is easing, and the economy faces headwinds. So as a result of those factors, policymakers stood pat and actually expect inflation to fall in the 2 to 3% target by the end of 2025. We discussed yesterday in our preview how inflation has progressed. Of course, the projections are conditioned on the assumption that rates have peaked and will fall in the second half of the year. So there is sort of an implied prospect of peak rates and lower rates there. However, that's not a forecast, that is an assumption around market expectations based on which these projections are conditioned. Now, however, officials stressed the need that they need to be confident that inflation is moving sustainably towards the target range, echoing the Fed from last week, and did not talk about rate cuts. On the contrary, they warned that further hikes cannot be ruled out, while the governor said that there is more work to be done. So all in all, we would say that that there was a hawkish tilt, it was a hawkish hold, even though it is quite likely that rates may have already peaked. The central bank is at or near peak rates. Now, AUD USD has slumped this year due to shifting Fed expectation and the disappointment from last week's pushback and the strong NFPs. It is exposed to the 76.4% Fibonacci of the last leg up at around 1.64, around that level. But further losses towards the 2023 low at around 162.69 do not look that easy. The policy differential can support the Aussie, as the RBA has not taken further tightening off the table and has more work to do on inflation clearly, whereas the Fed has pointed to 3 cuts this year and is definitely closer to a pivot. The RBA, as we said, offered a hawkish hold today, and the initial reaction was higher for the Aussie. This could help it rebound, but the immediate upside is not particularly friendly. Daily closes above the 200-period EMA at around 0.66. It would be needed for the downside bias to stop, but we are a bit cautious around the ascending prospects at this point. Now let's move to the euro dollar. We talked about how the NFPs and the Fed dealt a double blow to the pair. We analyzed that. And let's remove those marks from here just to have a clear chart. There has been a repricing around the policy path of the Fed. The pair runs its fourth losing week, which exposes it to the 76.4% Fibonacci. But again, we're a bit cautious at this stage for further weakness. We had said what we had warned yesterday, how the December lows, this highlighted area we highlighted yesterday, could help the pair find some reprieve, and it did find some reprieve. There is scope for upside because the ECB is more hawkish compared to its US counterpart. So there is scope for the pair to try to reclaim the 200-period EMA at around 1.087. But the upside does not look particularly friendly from a technical perspective, even though on the face of it, fundamentally, it can find support. And if we look at the daily chart, we could also add the Ichimoku cloud, which you can also see provides another roadblock. Rebound. And of course, fears around supply, mainly non-OPEC supply, because the OPEC and allies such as Russia actually strengthened output cuts for the first quarter. We haven't heard about what they will do next. Now, having rejected the critical 38.2% Fibonacci of its September-December slump, this region here, this is a critical technical level, and having already moved below the 200 period exponential moving average, there is a clear risk for lower lows, which are located at 67.69. On the other hand, the hostilities in the Middle East, we have touched on this subject on previous sessions. The Middle East is an important energy hub. We have seen hostilities in the Red Sea, thus leading ships, oil tankers or not, to reroute or to stop passing through the entry to the Suez Canal, and that is supportive of oil prices. So we can see another effort for the 38.2% Fibonacci, but there's not, I don't feel confident for much more than that. The next major resistance is located at 84.9 in any case, but that feels very far. Overall, we're seeing that there are competing forces here. There is fear around increased supply, but we see this constrained by the Middle East hostilities, and there is also prospect of easier policy by the Fed, but for now this is pushed back. So definitely competing forces there that could keep an equilibrium around current levels. And with 2 minutes in the US session, let's talk about the Nasdaq. Not much to say really. Again, there's no fresh catalyst to change things. A bit of a mixed bags on the mega caps earnings, but Meta and Amazon definitely knocked it out of the park and helped the index. There is a repricing around the Fed. There is a moderation in expectations, but the pricing is still aggressive. So this can continue to be supportive. It seems to be on track to take out the 18K handle, but given those headwinds and this slowdown recent over the last few days, there is room for a pullback, but daily closes below the 200 period DMA at the 17K handle definitely will need a very strong catalyst. If we have those, then the bullish bias would be endangered. And let's round things off with Disney, the entertainment media giant, which had a rough 2023 because its traditional linear assets faced headwinds from cord cutting and an unfavorable advertising environment. Its studio division lacked box office success, and there was fatigue around its Marvel Cinematic Universe, while its streaming services lost subscribers and conceded the top spot to Netflix. While on top of that, there was also some boardroom drama as well. Of course, this reflected to the stock, which extended the slump of 2022 to reach the lowest levels since 2014 in the last quarter of 2023, but managed to eke out gains last year and made a strong start to the current one. The reason for this rebound that we're seeing after that multi-year low is that the company has taken action to turn things around, and there are already promising signs with CEO Bob Iger, the legendary CEO, offering an optimistic message in November, pointing to a new era of building. Now, the company returned to uh, streaming subscriber growth, and let's actually see a graph to highlight that. You can see we expect the latest results, but you can see it has stayed below Netflix after losing the top spot, but in the last quarter there was an uptick in subscribers. Furthermore, the financial of the streaming sector segment continued to improve. We can see that net losses, of the streaming segment continued to narrow, and the company expects profitability within this year, and revenues also had an uptick in the last reported quarter. Of course, the next quarter, the latest results are announced on Wednesday after markets close. A few things to watch out for is, of course, the subscriber figures. The company is making strides with its ad supported tier, so any more color around that will be important. And it also plans a crackdown on password sharing, which worked well for Netflix and gave it a growth pathway, a growth runway. So we want to see more details around Disney's plan, and of course any talk around ESPN, which the company has stated it wants to transition into streaming as sports become increasingly more important. And Netflix also announced its entry into the arena, which is likely going to be a key battlefield going forward. Now, technically, uh, it's in a very interesting place because after its recent rebound, it has formed a technical golden cross, which is often a precursor of sustained strength. Golden cross is when a faster moving average crosses above a slower moving average. I personally prefer uh, exponential moving averages of 50 and 200 days. So that's the golden cross that we have here, and that definitely creates prospects of further gains. But this, of course, remain to be seen if it will work like that in this instance. The last time, however, this had such a formation had occurred was all the way back in 2020, right after the pandemic planned, and had opened the road to the record highs that ensued. So definitely we could see this play out again, a similar move. The next target is at around 104, and after that we would be close to $120. On the other hand, and if we look at the RSI, there are some overbought conditions here, so which could contain the upside and create renewed pressure. However, you can see that the downside is well protected. We have the exponential moving averages, we have the January low, and we have a thick daily Ichimoku cloud, and a return back to the multi-year lows does not look that easy. So that's pretty much it from me for today. Thank you for joining me. We will talk again tomorrow, Wednesday, at our usual time slot, 10 minutes before Wall Street opens.